Hey everybody, I hope you had a wonderful Thanksgiving and can't believe it's already December. That is just crazy to think that we're like 30 days from 2025. In any event, it's been a wild year. Bonds have been all over the place, rates have been all over the place, and we've got some good news actually this week. If you look at the chart over here, you can see that we've been in this downward slide since September, and it goes back to when the Fed cut the rates by half a point. They cut short-term rates. A lot of people get this confused, and they think the Fed's cutting mortgage rates. This chart proves the Fed does not set mortgage rates. Mortgage rates are driven by inflation and economic data, and when the Fed cuts rate, it's for short terms like credit cards, car loans, 10-year investment bonds or treasuries and so forth, CDs that are 10 years and less. So here you can see that we've been in this downward trend. And again, when the bonds drop in value, mortgage rates have to go up to offset it. So you can see that we've been in this downward cycle for quite some time. And right leading up to the election, the Fed meeting back on November 7th, we had like 2 weeks of where things were just bottomed out. It was just back and forth, back and forth. The market just wasn't sure what was going to happen, what was going to be the future, where things were going to go. And we finally have got a few things that have settled in place, and we've started to see this upward trend. And again, you want to see the upward trend in the mortgage bonds because that's what's pushing mortgage rates down. The higher the bond yield goes, the lower the mortgage rates go. So you want to see this upward trend continue. And we're about halfway back to where we were in September when rates were in the high fives to low sixes. So this week will be pivotal. We've got the JOLTS report on Tuesday. We've got the ADP report on Wednesday. Powell's also speaking on Wednesday. The continuous jobless claims are coming out on Thursday, and then the the unemployment report on Friday. So if we can get some favorable jobs numbers here, and the Fed's been alluding to the fact that, okay, the jobs market's not as strong as the reports are showing. And that's a key critical thing because they always say they're data dependent. Well, the data's flawed. The data has gone back, and they restate these every month, and they have shown that they've overstated jobs by over 1 million jobs over the last year. 1 million jobs over the last year that they said were there. And then after the fact, when they recounted and calculated things again, they were overstated. So the market responds on that juicy jobs number. And if we actually had these weaker job numbers come in here, the Fed would be doing something totally different. They'd probably be cutting rates more. So there's a lot of things about this week that, like I said before, can be pivotal. But if we get some favorable jobs numbers, we'll continue to see the rates drop because the mortgage bonds are continuing to go up, and that is what we want to see. So if you got any questions, check it out. Other than that, you guys have a great week. We'll be back in touch next week.